Hi everybody, welcome back to one more cost flow assumption exercise. In prior videos, we've already practiced with the average cost, FIFO and LIFO methods. In this video, we will work with specific identification. As mentioned in earlier videos, the specific identification cannot be used unless a company has the ability to specifically track a piece of inventory back to its purchase invoice. Obviously, if you're selling gallons of milk, there's no way to identify 1 gallon of milk from the next, and therefore it would not be possible to trace back an individual gallon of milk to a specific purchase invoice. Therefore, specific identification is usually only used by companies selling unique, expensive products with low sales volumes, which make it relatively easy and economically feasible to associate each item with its actual cost. And the example given was automobiles have a VIN, a vehicle identification number. It's a unique serial number, and that serial number can be used to match the cost of that specific in automobile with its actual purchase price. So in this example, obviously, you can't pull purchase invoices and look at a specific unique serial number, but you do need some practice with specific identification. So for that reason, I'm giving you sufficient information to be able to apply specific identification. I have provided you with the following information. The January 10th sale consisted of 2,000 items of the beginning inventory. The April 15th sale consists of 800 units of beginning inventory plus 300 units of inventory purchased on January 17th plus 400 units of inventory purchased on March 22nd. And the November 20th sale consists of 1,000 units of beginning inventory plus 2,000 units of inventory purchased on October 15th. So you will need this data sheet, and you will need your specific identification spreadsheet. Browning Company Cost Flow Assumption Specific Identification. And for ease in doing this video lecture, I have duplicated the inventory data from the data worksheet, and I've also duplicated the specific identification assumptions about which items were sold from the data worksheet here, so I don't have to flip back and forth. Again, the cost flow assumption method will make absolutely no difference in inventory or cost of goods sold until items are sold from different layers of inventory. Therefore, the January 1st, January 10th, January 17th, and March 22nd transactions are all identical. Your cost of goods sold, your ending inventory will all be identical to the worksheet you have already prepared for FIFO, LIFO, and average cost. So go ahead and complete the specific identification worksheet through March 22nd. But hold on before you get to the April 15th sale. Check your work through March 22nd, and then we'll do the April 15th sale together. Beginning inventory on January 1st consisted of 4,000 units at a cost of $550 each for $22,000 total inventory at that date. On January 10th, we sold 2,000 units at a cost of $550 each for $11,000 cost of goods sold. 4,000 were available minus 2,000 that were sold leaves an ending inventory after that sale of $2,000 items at $550 a piece equals $11,000 of ending inventory. Cost of goods sold, 11,000 plus ending inventory of 11,000 does equal the inventory available for sale immediately before that sale. Carry down this layer of inventory to the next date box. Then record the next layer of inventory on the January 17th purchase. 1,000 items times $6 a piece equals $6,000. Total inventory available for sale after the January 17th purchase then is $17,000. Carry these two layers of inventory down to the next date box. And March 22nd layer, 3,000 units at $7 a piece equals $21,000. Added to the two prior layers means that after the March 22nd purchase, we have goods available for sale of $38,000. Now we're going to calculate the cost of goods sold under specific identification and ending inventory after April 15th sale. So let's get started with that. April 15th sold 1,500 units, and specific identification as presented in this class is kind of like following a recipe. The April 15th sale consisted of 800 units of beginning inventory, 300 units of inventory purchased on January 17th, and 400 units of inventory purchased on March 22nd. So just fill those three lines in times the cost that we paid for those items, and you will calculate cost of goods sold. Go ahead and do that, then come back and check your work. 800 units of the beginning inventory with a cost of $5.50, $4,400 as part of cost of goods sold, plus 300 units from the January 17th inventory, which had a cost of $6 per unit. 300 times 6 is $1,800 cost of goods sold for those items, plus 400 units of inventory purchased on March 22nd at a cost of $7 each. 400 times $7, $2,800 for those items. Add it all up, and we have cost of goods sold under specific identification of $9,000 for the April 15th sale. Now we need to figure out how many items we did not sell and calculate the cost of our ending inventory under specific identification. I'll get you started, then I'll let you finish it up. We had 2,000 units of beginning inventory available. We sold 800 of them. That means we did not sell 1,200. And they have a cost of $5.50 each. $6,600 of inventory remaining for the first layer. You go ahead and finish up for the next layers and calculate your total inventory, ending inventory after the April 15th sale, and then test your math. Does cost of goods sold plus ending inventory equal the $38,000 of goods available for sale immediately before the sale? Do the work, come back and check your answer. Did you come up with $29,000 of inventory after the April 15th sale? And the $9,000 of cost of goods sold plus the $29,000 of ending inventory does equal the $38,000 of goods available for sale immediately before the April 15th sale. So that's how specific identification works. You go ahead and finish up the worksheet for the October 15th purchase and the November 20th sale. Don't forget to carry your layers of inventory down to the next date block. The first thing I did was to carry down these 3 layers of inventory left over after the April 15th sale. Then I added the new layer of 3,000 units purchased on October 15th at a cost of $7.50 each, for a total of $22,500 for that layer. I added up all the layers and determined that under specific identification, we had $51,500 of merchandise available for sale after the October 15th purchase. Then I recognized that we sold 3,000 units on November 20th, and I simply followed the cost recipe given to us. 1,000 units of beginning inventory and 2,000 units of inventory purchased on October 15th. 1,000 of the beginning inventory at a cost of $550 equals $5,500, and 2,000 of the inventory purchased on October 15th at a cost of $7.50 each equals $15,000. Add those two together, and cost of goods sold for November 20th is $20,500. The inventory that we did not sell, we sold 1,000 from the beginning layer. We had 1,200 available. We sold 1,000 of them. Leaves 200 not sold. 200 times $5.50 equals $1,100. We did not sell any of this layer, so that full layer is put here. We did not sell any of the third layer, so that third layer is put here. We had purchased 3,000 units of inventory on October 15th, but we sold 2,000 of them, leaving only 1,000 of these units left at a cost of $750. Add the total cost of goods available for sale after the November 20th sale, and we end up with $31,000 of ending inventory, and the math does work. Cost of goods sold of $20,500 plus ending inventory of $31,000 does equal goods, $51,500 of goods available for sale immediately before the November 20th sale. Then to finish up the worksheet, I hope you did finish it up. The cost of goods sold under specific identification is $40,500. That's the $11,000 of cost of goods sold from the first sale, plus $9,000 of cost of goods sold from the second sale, plus $20,500 cost of goods sold from the third sale, plus ending inventory of $31,000 does equal $71,500 of overall cost of goods sold for the entire year. Goods available for sale for the entire year. Well, that's all for specific identification and for this series of cost flow assumption videos. More later.